Okay, so it's 12:50, the time of our session, so we're going to begin. Hello everyone and welcome. I'm Kristen at TSIB. Here we are for TSIB's Construction Risk Management Seminar, Day 3. We are so excited to be here with you. I'm going to introduce our speaker in a moment, but first a couple of housekeeping notes. This session is pre-recorded, but we will have a live Q&A at the end. We ask that you stay on mute and off camera during the session. Anthony is here with us today, so if you have any questions, you can post them in the chat feature located at the top right of your screen. Anthony will also be chatting with us during the entire presentation, so as you're watching the video, you can post anything in the chat. But again, we will have plenty of time at the end for any questions. This session, including the Q&A, will be available on demand on TSIB's YouTube channel. Lastly, the material covered during this session presentation is for informational purposes only. It should not be construed as any legal advice, and it is highly recommended you contact your attorney for legal advice. So without any further ado, I'm going to introduce our speakers, Anthony Amicucci, James Pfieffer, and Jason Oswald, and they are presenting Is a Captive Right for You? We are so excited to have you here with us today, Anthony. Why don't you say a quick hello to everyone and we will get started.
Thank you, Kristen. Good afternoon, everyone. And just to add before we start, Jason Oswald is also on the call here, so he will be answering questions with me throughout the presentation.
Great. Let's begin. Talk to everyone soon.
Good afternoon. Thank you for taking the time to join us for our discussion today. My name is Anthony Amicucci. I'm a senior risk advisor and controlled insurance program specialist for TSIB. TSIB is a national construction insurance broker. We specialize in large construction projects. So we work with owners, public authorities, GCs, developers, creating project-specific programs. And we'll also work with the subcontractors that participate on these programs. We help them understand the requirements, help them build capacity, and purchase and manage their corporate renewable insurance programs. So really all aspects of construction are what we have our expertise in. I have my colleague with me, James Pfieffer of TSIB. James, do you want to describe a bit about yourself and your role at TSIB?
Sure. Yeah, thanks, Anthony. My name's James Pfieffer. I'm a director of insurance marketing at TSIB. Basically, what that means, I'm an insurance broker. I work with several different clients at TSIB, and I primarily help our retail producers find insurance markets for their clients for some of their more complex risks. And I also help our folks work with wrap-ups, specialty lines like professional pollution. Pretty much touched everything over the last 15 years. So if you can name an insurance product, I've probably worked with it.
Yeah, James has bought a lot of insurance for a high amount of construction volume over the years, and he's got very key relationships with the big construction underwriters. We also have Jason Oswald. Jason is the president and managing director of the Circa captive. Jason, would you like to introduce yourself?
Yes, thank you, Anthony, and I appreciate the opportunity to be here. My name is Jason Oswald, and I am the president and managing director for Circa Limited, which is a construction group captive based out of Bermuda. We also have our own captive management division and have a structure where we launch and help other like-minded contractors or just insurance buying companies create captive solutions. So we have captives domiciled in other parts of the country, and really find this a unique and exciting place to be in this market. So appreciate the opportunity to be here today.
Yeah, thank you for joining us.
Absolutely.
And James and Jason, they each really have a unique perspective on the industry. They control a lot of premium, and they have very influential relationships with underwriters. So their insight on the marketplace and these various programs, we think could be very valuable to the business owner. So we put this presentation today with the goal is to just at a very high level introduce what a captive is and really open your eyes to the fact that, hey, this is a program that we actually do qualify for, and it's something that we should consider over the next few years. So at the end of this, we hope you can answer the question, is a captive right for you? We begin today discussing the state of the insurance marketplace, which really comes down to one word at this point, which is chaos. The hard market is in full swing. We first saw signs of this in late 2019. A lot of our clients were getting sharp excess increases with really no claim activity. And then if you look back at 2020 on a whole, it was a really tough year. It began with wildfires burning through the West Coast. It was the most active hurricane season in U.S. history. Even in Q1 of 2021, the freeze that hit Texas for 2-3 weeks, it caused so much water damage and property damage. Insurance carriers are expecting it to be even more costly than the hurricane season was. And then there's COVID, which just shut down businesses throughout the world, and they're all filing business interruption claims. And overseas, it hasn't quite ruled here yet in the United States, but overseas, they're ruling in favor for business interruption. So these carriers they're just not making money like they're accustomed to. So it impacts how they do business across the board. And let's look at it on an individual basis. So James, can you elaborate a bit on how the hard market affects the traditional marketplace?
Absolutely. I mean, I think you left out a really important factor, though, about 2020. I mean, the murder hornets are what really kicked everything off.
Exactly.
I mean, I don't think anybody remembers those. On a more serious note, yeah, you're absolutely right. I think you hit the nail on the head, Anthony, as far as really what's caused all the chaos in the market, and chaos is the right word. On an individual line basis, I mean, I won't go through every coverage, but some of the big ones that impact our audience here, so general liability, we're still seeing a lot of pressure in the upward movement of pricing. We may see things ease a little bit in the third quarter or towards the end of the year when reinsurance treaties renew, but that's still sort of up in the air. I mean, right now we're seeing anything from flat to 15% increases, and those are for good accounts that are not really battered by heavy losses. On the excess and umbrella liability, it's even worse. I mean, we can see, again, good accounts getting anywhere between 25% to 100% rate increases year over year. That's what we've been seeing over the last 2 years to 18 months.
Yeah, it makes it very challenging, not as a business owner, just not having that control. You can be doing everything right, yet over a 3-year period, you can see your premiums going up over 100%. So it's tough. It's tough to navigate, and very much so in specific industries and locations, throughout the United States.
Yeah, workers' comp will be interesting to see how that shakes out too for 2020 and obviously into 2021. With we're obviously seeing claims go down a bit because everyone's working from home. Mm-hmm. So that is resulting in some cases in some downward pressure in pricing, but we still don't know what the full impact of COVID is going to have on workers' comp in terms of compensability. So that may offset any savings for reduced claims that we're currently seeing. So again, a lot of this stuff is up in the air. So chaos, definitely the right word.
Yeah, for sure. And then from the captive perspective, the hard market does impact that side of the industry, but it does in a different perspective. So Jason, we'd love to get your take on how the captive market's affected here.
Yeah, absolutely. Captives are not immune from rate changes, and I think that's important to know. You hear, what's going on in the traditional market. We've heard about the auto line of business for years and how carriers are struggling with that. And, captives are a way to kind of shelter you from that general noise. One of the beauties of captives is they're operating at a much leaner, much more focused approach. So their expense ratio is down. So they have, depending on the pricing, they have more dollars to put towards claims. So Again, the structure benefits, and we'll talk more about structure and why that is the case. But what we're seeing and what a good and a well-managed captive should be seen in a hard market is slight little bumps moving up and down, from a rate perspective. There's small little adjustments. A well-structured captive is going to protect the shareholders from these large spikes. As James mentioned, the excess market is seeing some pretty significant changes right now. What we've done with our captive is taking the group and leveraging the group to start increasing primary limits. What you're doing is you're now you're using the experience of the captive to push your primary limits up to a point where now you have more control over the pricing of those excess markets. You're getting more favorable terms, better coverages, and that's how we help our members, our shareholders, control this chaos. I mean, it's real.
Yeah.
And I feel for the contractors that are, and insureds that are dealing with this now. It's very real. But again, we have the ability, the structure to temper it.
Yeah, that's a big. So that's a key point in the hard market. On the traditional end, it just locks you up. There's nothing you can do. You're just kind of at the mercy of the insurance carrier. And while the hard market will impact your price and rating on the captive side, it just does it less severely. I like what you said, that they operate more lean. There's less underwriting cost and overhead that these captive has because it's not some gigantic insurance company. And it allows for more creativity as the price keeps going up in the traditional marketplace from the hard market. It allows more people to apply for captives, and like Jason said, they can increase their primary limit, which requires less excess. So there's more flexibility in the ability to be flexible in a captive to help offset the hard market in some instances. So it's interesting how the market affects both of these things in different ways. Now we'll shift and talk about, we've identified the hard market and how it impacts captive traditional. Let's now just simply define what a captive is. So Jason, the most simplest definition you can provide, what would that be?
Yeah, it's an insurance company that's owned by the shareholders or the members that are participating in the captive. That's the easiest and most straightforward definition of a captive. And that's really what we want potential prospects to keep in mind, is that you're creating an extension of your operating company. This is another business that you're buying into, and you got to come into it with that mindset, because just as you want in your business, you want high margins, you want to be making money. We as a captive also want to be doing that as well. So it's about the money, that getting dividends and returns is a big piece of what it is. So that mindset is extremely important when you're thinking about what is a captive and should I be joining the captive?
Yeah, so it's, let's kind of take it as a specific example. Let's take Circa, for example. So Circa's because there are different types of captives. There's single parent companies, single parent captives, where there's billion-dollar companies that purchase so much premium they can create and fund a captive on their own, which really, and Jason, you correct me if I'm wrong, the starting point on creating your own captive would be around $3 million in premium collectively along all lines of coverage, whether that's coming from one company or that's coming from 10 companies or that's coming from 100 companies. That's kind of where you would have to start, and depending on how many people dictates what type of captive you're creating. So, there are different types, and
You're absolutely right, and as you mentioned, there are different types, and you got to understand what kind of risk you're willing to take. Some folks might be a larger company where a single parent would make sense for them, but they really want that group aspect. So a group captive is a better approach. Again, I said at the beginning, what is a captive? And I said it is a lot about the money, but there are other pieces that are extremely valuable. In a group captive, you're going to get that peer aspect. A well-run and a collaborative group captive is you're going to be sitting at the table with like-minded contractors or whatever trade you're in, and you're going to be sharing best practices, whether it's across the table from your safety directors, CFOs, owners. And that's an extremely valuable resource within the captive. We sometimes get caught up on how much are you paying in premium and what's my dividend, and I think that's also a really important piece. So because of that, again, you really have to step into it and first identify what are your goals in the captive, what do you want to achieve, and that will dictate whether or not you go to a micro captive or an 831B captive or a group captive or a single parent captive. There's a lot of great options out there, but it really starts with that first question.
Right, exactly. There's a lot to consider. It's a complex solution. It's not something where you just wake up and you said, hey, I got a renewal coming up in 30 days. Let me jump into a captive. There's a learning curve. You really need to take your time. It requires some upfront capital, and it's a long-term play. It's not something that you come in for 1 or 2 years and you leave that third year. You want to remain in that captive basically for the existence of your company. The longer you stay in it, the more premium dollars you put in it, the more value you get out of it. And when you get to year 4, 5, and 6 of and on of the captive, they're going to look back at the first years 1, 2, 3. How did you perform? If you performed well and you didn't have many claims, you get a return of premium in the form of a dividend. That could be, in some cases, up to 60, 65% of the premium. So it's a really attractive tool, but there is, it's not the simplest thing. So it takes a bit of time to get familiar with it. Okay, so now we've defined what a captive is, the basic framework of it. Let's talk more about the comparison between traditional versus captive insurance programs. And let's really focus on the value of the dollar. $1 premium spent on a traditional insurance policy is a lot different than $1 premium spent into a captive insurance program. So Jason, can you kind of dive into the value that your premium dollars have and how you can, as a shareholder in a captive, how you can dictate where that money's spent?
Yeah, absolutely. And that is the beauty of the captive. I mean, as you said, Anthony, when you buy a guaranteed cost product or, high deductible, you're paying that premium to the carrier, and that money is gone at that point in time. You're still buying a very similar product from a financially strong and capable carrier, but what's happening in the captive is we have a reinsurance agreement with the carrier. And because of that agreement and because of the risk that we're taking, that dollar in that you would pay in the traditional market, we're going to take a portion of that back. And what we're going to do is we're going to take and we're going to invest that. We're going to hopefully earn some investment income on that money over time. We're going to use that to pay claims over time. And ultimately, those are the funds that, if we don't have to use over the course of the policy year, that we get to give back in, premium returns or dividends. The other beauty is that because we're taking that money and we're building surplus within the captive, again, keep in mind that the captive is, a company that you own, and it is about the money. We're taking and using that surplus in different ways. So because we have taken and broken down the services that we're providing, we can get very focused with what we're doing. Again, claims and risk control are the 2 key components in a captive that makes it successful. So for example, when you're building that surplus and you have the money set aside, we can take a look at the experience of the shareholders within a captive, and we can drive very specific services using those premium dollars to the members. Whether that be, implementing in-cab cameras to help control fleet exposures, or doing nurse triage programs on the work comp to help control those claims. Again, those are things that are highly focused in using your dollars in different ways to drive better results and better returns for those participants.
That's a huge value add over the traditional program, because in the traditional program, your premium's $500,000 a year. That's it. Those dollars, that's a sunk cost. It's out of your hands, and you don't see that at all. The carriers tell you, yeah, we have loss control, we have safety professionals, we'll send them out and do an audit. but most of you participating on this session have probably gone through that, and there's really not a whole lot of value to that. A risk manager from the carrier gets on a phone call with you and has a 30-minute discussion. But for a captive, you vote as shareholders what you want, and we want cameras inside the cars. We want more PPE on the construction site. We want a safety manager to go visit all these job sites for the members of the captive and provide reports. There's there's many options what you can do with that money, and it's a major advantage on the traditional end. And don't get me wrong, a traditional insurance program is effective. We're not saying that it's some terrible option for you. And depending on where you're located and what type of risk you're trying to insure, it could really be a competitive price and the best option out there. But if you are that sophisticated company and you look to the long term and you pay attention to safety and you have that culture, the captive becomes much more than just an insurance policy. It's a profit center. It's another avenue of your business. I mean, Jason, let's take Circa for example. There are probably somewhere 12 to 15 members of that today, and those members are extremely active. They recruit, they try to bring in other businesses that they know operate the same way they do, because they know if they bring in more quality contractors, more quality companies who are paying high premium dollars, it's more value to them. So it becomes much more than an insurance policy.
Absolutely, it is, and it's it's fun to be a part of that and watch that. The other side of this is we're talking about the preventative piece of it. I think the other big difference between traditional and captive is in that unfortunate event when you do have a claim and it is sitting on the books that is using that claim. The traditional is, you might have a voice, but again, you got to keep in mind that carrier is thinking about their balance sheet and going to make a decision on your claim based on what they're trying to accomplish within those goals. So a captive is, at least the way Circa works and in a lot of captives is you have a voice to settle claims up to a certain amount. You're speaking into whether or not you want surveillance, whether or not you want to fight a claim or just be off of it. So it's again, we're doing, we're handling claims in a responsible way, but again, you have more control, as you've clearly identified on this slide. Right. And I think that's a very powerful piece.
Yeah, exactly. So at this point, let's say you've identified that you've decided as a company, you like it. You want out of the traditional marketplace. You want to turn your attention towards captives. You want to apply. So what does that look like, Jason, when someone applies to be a part of the Circa captive? Can you walk us through that process?
Yeah, we can talk about Circa, but I also want to highlight that each captive is going to be a little bit different in terms of what that process looks like. For smaller contractors, if you're looking to get into a large group captive, that process might move a little more quickly than what I'm going to outline for Circa. But I think the scope of what you can expect as you're entering into this process is pretty similar. Keep in mind that there's a little more scrutiny on you as you're applying. So don't be surprised when they ask for more than just your exposures and loss runs and your financials. I think a well-run and responsible captive is going to really focus on those two other pieces that we've mentioned is, what are you doing, from a claims perspective? Do you have a team that can speak into those and be ready to advocate on your behalf? And then what are you doing from a safety standpoint? What's the culture? We spend a lot of time talking about what's the culture within a company because you are trying to find the right fit. As Anthony said, this is not you just jumping into a captive this year, then going out and shopping, price again next year. This is a long-term commitment because the goal is to, again, build that profit within the captive and have this as a profit center, for an extended period of time. In terms of the application process, again, it's going to vary. It could take, 90 days. It could take a little more to walk through that process. So we really encourage contractors that are starting to think about this, that are, frustrated with the current market, to get out there now, start asking questions. you need to interview us as much as we're interviewing you.
Yeah, and feasibility studies.
Yes. So depending on the size, you might want to do a more complex or robust feasibility study. For us, what we'll do is when we take in that information, when we get your exposure and your losses, we'll do a feasibility study, which is really just a historical look back and say this is how we think you would have performed if you were in the captive over the past 5 or 10 years. I mean, it really gives you that unique perspective, and that's I think what a responsible captive or broker should be doing for those members.
Yeah, definitely. It could be very it can be very detailed, and it's not all that difficult to apply to put together. So there are many captive brokers out there that you can reach out to, and they would happily do this feasibility study for you. They'll gather all the information on the past premiums you've paid, the claims that you've incurred, and they can tell you pretty close to what you actually would have performed in those past 10 years. So you can get an evaluation right there. Hey, you could have saved X amount of dollars over traditional insurance. You could have received this type of dividend over the past 10 years based on your claims activity. So that would go a long way for you to really say, okay, this is an option that's right for me. And then, when it comes to actually filling out the applications, doing the paperwork, it's very similar to what goes into the traditional renewal, the traditional submission. However, they'll just ask for more info, more history, financial info. There is a layer of collateral that would be required for a captive program. So not all traditional programs require that. So they do have to do, financial reviews to make sure everything.
Deep dive into their losses.
What's that, James?
Deep dive into their losses too.
Yeah, exactly. So those are the things that matter. If you had claims, how have you addressed them? How have you changed things from a management perspective to prevent them from happening in the future? So it's just like if you're able to they're accepting you on because if you have the fundamentals of a contracting company that's going to sustain itself and be profitable. So you want to be accepted. If you get accepted and you're on that path, that means you're doing things right and you're giving risk management the proper attention that it deserves. The premium dollars are so high these days. It just can't be ignored. You have to get more than just potential insurance coverage. And if you're growing and you're not having claims, your premiums are still going to keep going up. And the value that you're getting out of that remains the same. So, it is a bit of a process. There is a learning curve, but it's something that could be extremely profitable and beneficial to your business. So and now because the hard market has gotten so tough and prices are really out of control a little bit, there's more flexibility within these captives. They're evolving. They smaller businesses apply for captives more so today than they did previously. So it's also a good indicator of what the quality of your broker is. If you're paying over $250,000 a year and you're not being educated on these items, that should be a red flag for you. It's something that you should be, that's information that you should be getting from your brokers.
I would say it's good to point out.
Go ahead.
Okay, why don't you go ahead, Jason?
And I was just going to say, I would encourage, those on this call that, don't be afraid to ask the questions about captives. In my experience, I've had some people that have approached us and we do the historical comparison and they say, well, I didn't think I would be a good fit 2 years ago. And they realize that they've left, quality money on the table over those 2 years. Or on the flip side, they think they're, a great fit, and we come through and we do the analysis and we identify, some areas where they can focus over the next 3 years ahead to get them ready for the captive. I think that that's the important piece is I, at least in my role, I very much encourage folks to send in the information because it is a long process, or it can be a longer process than just buying in the guaranteed cost market. And I'm very much about being upfront, and these are the things that maybe we can work on and get you in and get you ready for the captive, working with your broker to make that happen 2-3 years down the road. So again, I do not let one event or one experience maybe sway that decision. Again, it's always in my mind very healthy to have the conversation and walk through that process.
Yeah, no question. Knowledge is power. Learn about the product because it very well could be a good fit for you.
Yeah, and another thing to point out too is that I think we've done a pretty good job of painting a pretty doom and gloom picture of what the market looks like, and it's not inaccurate. But the good news is that markets in all sectors, not just insurance, they go up and down. They get hard and they get soft again. But the one thing that you can absolutely count on, and Anthony hit on this a minute ago, is that long-term costs are always going to go in an upward trend. And so the question is, how do you get the best value for those dollars long-term? I think at least it behooves you to at least explore how a captive can help your business.
Exactly, and that was the goal of this presentation today, to get you all thinking about that and to ask yourselves these questions. So we hope you found the information useful. James, Jason, and myself are available for questions now, and please don't hesitate to reach out to us at any time. We'd be happy to speak with you all. James, Jason, thank you for everything, and look forward to talking to you all soon.
Thanks a lot.
Thank you.
Thank you, guys. That was a great presentation. If anyone missed any of the presentation or would like to re-listen to it, don't worry, it will be available next week on demand. So for now, let's open up our Q&A portion. I see that we have a few questions that came in. First question, can you talk more about risk sharing? How does someone else's claim affect my business?
Yeah, that's a good question, because that is a big factor, a big component of the captive structure. So the other members of it, if you were to join a captive, the other members, the other shareholders, the other businesses a part of it, if they incur catastrophic claims, there is an element of risk sharing. So there will be, if it's a $1 million claim, for example, the first $200,000, $250,000, $300,000, whatever, however that captive is structured, that first portion of the claim will be paid by the individual company. It then a bit gets picked up by the insurance carrier itself, and then there's an element of the risk sharing. So it's only in a catastrophic nature, and it happens. It's not terribly frequent, but there's no doubt that it does happen. Jason, anything to add on that?
No, I think you said it perfectly. Each captive is going to be a little bit different, and I think the key is that you want to get that snapshot of the captive's performance. You want to know how often have they had a shared event. What caused that shared event? How is the captive funding for those large severity losses? 3, 4, 5 years down the road. I mean, you got to keep in mind, captives tend to have work comp, general liability, and lines in them, and those are not lines of coverage where what your claims, your total value is going to look like, tomorrow. It's several years down the road. It takes a little while for those claims to develop. So I think those are really important questions. And again, each captive is going to be a little different in how they share. They might share proportionally based on premium. They might share it based on your revenue size. Those are important things to figure out on the front end. Good questions to ask. Get their pro forma, get their historical financials, and ask about shared events.
And the other thing is, when you do evaluate captives, this is public information, so you can evaluate and look at the past history of the captive you're considering and see how often a claim hit that resulted in risk sharing. So it's definitely an important question and an important thing to consider.
Thank you both for that. We do have some more questions. The next question is, what happens if you want to leave a captive? Can you be thrown out?
Yeah, hopefully you don't want to leave and it all works out well for you, and you can be thrown out of a captive. Jason, what would it take for that to happen?
Yeah, and here's another great question, and another thing that you need to ask for when you're evaluating the captive is their governing laws. It's a private placement memorandum for Circa, and it's going to outline what happens in those scenarios. Can you leave a captive? Absolutely. You got to keep in mind that you're going to leave your collateral in place, and a lot of captives are going to step up the amount of collateral that they require when you exit a captive because they no longer have inbound premium. So you need to make sure that you understand what that is going to look like for you upon exiting the captive. In terms of poor performance, every captive, like I said in the presentation, is it's a business. We're looking to make protect our margins, build surplus, and return profits. So if we have a shareholder that's not performing up to our standards, our best practices, we're gonna first have a conversation with them and highlight where we think there are deficiencies, how we can come alongside them, help improve that process for them. If we can't get buy-in from that owner or that company just can't make that transition, then over time, we have to protect the business, and we're gonna look at that to potentially remove that person or that company from the captive. Fortunately for us in Circa, we haven't been faced with that situation. Other captives have. It's not an easy conversation, but I would say a well-run captive, one where you have active members, it's a conversation on the front end. It's not an immediate knee-jerk reaction to kick someone out. Especially when you're dealing with contractors, there are severity losses. Everyone's going to have a year where, you just have a claim. And again, that's why you build scale. That's why you build surplus to weather that storm.
Yeah.
There's some more questions. What are collateral requirements? How do they impact my business long term?
So collateral requirements, they get brought into the mix when you have a loss-sensitive plan, when you have a high deductible. Typically you start seeing collateral requirements when there's a $250,000 deductible or higher. And basically what that means is the carrier requires that there is some collateral posted in the event that a claim is incurred and the carrier is coming out of pocket to pay that deductible, and the business doesn't reimburse them, doesn't pay that deductible bill when it hits them. So in that instance, the carrier would call down on the collateral to pay the cost of those claims. So, typically businesses that are accepting these types of programs that are collateralized, they can afford it, they're well run, and the collateral never really gets touched. So they have to put it out there. It has to remain out there as you renew the program. And the real negative to it is if for whatever reason you leave that program, whether it's a captive or just a traditional high deductible program, that carrier is allowed to hold that collateral. And it's really on an open-ended basis. They'll hold it because they want to wait. They have to wait for your claims to develop, because construction claims develop over time. It doesn't happen right away. Sometimes 3, 4, 5, 6 years down the road. So unfortunately, the contracts that they make you sign for these types of programs are very strict. And if you do want to leave that type of program, your collateral could remain out there for a significant period of time, years on end.
Great, thank you so much. And thank you everyone for spending time with us today. I don't see any more questions. So don't forget to join us tomorrow for our next session, Understanding the Surety Claims Process. That session's link can be found on the seminar page on TSIB's website or in the reminder of events email you received earlier today. If you have any other questions, please feel free to reach out to us anytime, and we'll see you soon. Thank you.
Thank you.